welcome to the show. I normally say that this is the show where we share the stories of the many who intersect with our healthcare system but are rarely heard from. But I'm sure all of you have heard of my next guest, Jim Dahle. He's an emergency physician. He's the founder of the White Coat Investor Empire. His latest book is The White Coat Investor's Guide to Asset Protection, How to Protect Your Life Savings from Frivolous Lawsuits and Runaway Judgments. Jim, so happy to have you on the show.
Wonderful to be here. Thank you for having me.
So I think it's fair to say that you've created a new asset class of content, which is the healthcare professional personal finance space. But I want to go back to the very beginning. You wrote The White Coat Investor back in 2014. You're an emergency physician. So what triggered you to take that next step and write a book on healthcare professional personal finance?
You know, it's interesting. I had the blog before the book, and the inspiration for the blog was I just got sick of typing the same thing over and over again into internet forums. So I thought I'd put it in one place, and then I could just post links in forums to people that are asking questions. And the book kind of grew out of that. My blog readers kept telling me, you should write a book, you should write a book, you should write a book. And they were right. I needed to write the book. And the interesting thing about writing the book, if you've ever written one, is all of a sudden, once you published a book, everyone views you as much more of an expert than before you published the book. No matter how good the book is, whether it's self-published or not, it's this thing out there that really establishes you for whatever reason in people's eyes. So I found that very interesting. But the inspiration behind it all was I just got sick of getting ripped off myself by financial professionals. And so I embarked on basically a self-study course to learn all this money stuff. And I found it really interesting, just as interesting as I found medicine. And after a few years, I realized I loved teaching it as much as I loved learning it, and that nobody else was teaching it to doctors. So I kind of embarked on a Don Quixote-esque quest to fix doctors' financial illiteracy problem.
So you have multiple books now. You have the podcast. You're all over Facebook. Obviously, you have the website. Now, why do you think that this topic has resonated so much? Why are you so successful with this?
I think part of it is simply that I was able to speak to doctors in their terms. You know, it's an important subject. Trainees, students, attending physicians, they all love learning this stuff. They're really interesting to them, but nobody spoke to them in their language before about it and explained how it works from their point of view. And so I think it was not that the information was totally new and not that the audience was totally new, but I was able to blend them together in a way that really hadn't been done before. And I think that is why it became so successful.
So what's an example of that? What do you mean by speaking to physicians in their language as it relates to personal finance?
Well, for example, doctors have this view of other professionals where, we're guided by the Hippocratic oath. We basically raised our hands and sworn we're going to first do no harm. We're going to put our patients' needs before our needs. And we get this misunderstanding that that's the way the rest of the professional world works. And particularly in financial services, that is not the way the world works. They do not have a Hippocratic or fiduciary duty to you most of the time. They're trying to sell you something. And so just kind of empowering doctors to realize that it's not the same as calling a GI consult when you call up somebody looking to get insurance. You need to be a little bit more on your guard, I think is really helpful perspective for them to gain.
Now, you've been doing this for 10 to 20 years now, it's fair to say. And what's the situation like now when you talk to other physicians or you go on your Facebook groups or your message boards? Has personal finance, is that more on a lot of healthcare professionals' radar? What's the situation now compared to, say, 10 years ago?
Yeah, I think we've made a lot of progress. And I can't claim that I am the only person out there doing this. There are other people blogging and podcasting and writing books and trying to help in any way they can. And so I am seeing progress, and that is absolutely really fulfilling to me to feel like we're actually making a difference. But it's not as much progress as we need to make. Doctors are still, particularly mid-career and later doctors, are still not particularly financially literate, still making the same old mistakes. And there's not as much room now to make mistakes. There's pressure on physician incomes, especially with the trend toward employment. And people are coming out with so much more debt. There's just not the room to make the mistakes the doctors used to be able to make and still be okay. You've got to make a much higher percentage of your financial decisions right these days in order to still have a comfortable retirement as a doctor.
Now, on this podcast, on Kevin MD, and I'm sure that you're certainly familiar with, that a lot of physicians are struggling with burnout. The numbers are 50% before the pandemic. Now it's like 75%. Now, There's a concept of financial independence, and that is a solution for burnout. Comment about that intersection between financial independence and as a solution to physician burnout?
Yeah, well, part of the issue with burnout is you can't buy insurance against it,
Hmm.
right? I mean, it is more common, like you said, 50% plus of physicians have burnout. Now, it's not quite that many that leave their practice because their burnout's so bad, but even that number is pretty significant. And we buy disability insurance to protect ourselves from disability, which is only about a 1 in 7, chance of becoming disabled for a period of time. Burnout's much higher, but you can't buy insurance against it. And so you need to really be taking those steps during your career to maximize your longevity in the career. So every time you are faced with the decision, you should be thinking, what is going to allow me to practice longer?
Hmm.
Is probably one of the most important things. Now, financial independence is the ultimate burnout treatment, right?
Yeah.
If you're totally burned out, you don't want to practice again. Well, if you don't need the money, you can just leave, and so financial independence is the ultimate burnout treatment. But my hope would be when people have their ducks in a row, their financial ducks in a row, that they don't need to go all the way to that extreme, that they can simply cut back on call, that they can change jobs to a less toxic job, that they can find those things about their practice they love their most, and be able to spend their time doing that rather than what pays the best, because they have all this financial pressure to make student loan payments and mortgage payments and payments on a second house or a boat or a couple of Teslas or whatever. And so I think there's a lot of benefit to being financially literate even long before you become financially independent.
So when you talk about all your financial ducks in a row, like I said, you've been doing this for so long. What are still common red flags that you see physicians, or mistakes that physicians commonly still make in 2022?
Oh, I mean, it's the same ones we've been making for years and years, and frankly, that a lot of Americans make. It's not necessarily all physician specific. We tend to buy the wrong insurance. We don't buy
Mm.
enough of the stuff we really need, such as personal liability insurance or an umbrella policy, and a big old term life policy if anybody else is depending on us, or disability insurance. And instead, we buy a bunch of insurance that we don't need. We insure our iPhones, we insure our vacations and that sort of stuff instead of having the insurance we really need. So that's a big one. We still spend too much. I tell attending physicians they really need to be putting 20% of their gross toward retirement. That's in addition to any money you're saving for college, any money going towards student loans, et cetera. So we spend too much, just like every other American. That's a big problem. We get suckered into investments and insurance products that are designed to be sold, not bought. The classic one is whole life insurance. And just about every physician has whole life insurance pitched to them at some point when they're a resident or a young attending. And too many of us are buying a product that's right for probably only 1% of us. So that's a big common red flag. Most of us are either getting bad advice, not getting enough advice, or paying too much for good advice. So that's a big red flag. A lot of doctors just don't know the going rate for financial advice, and they don't know how to recognize when they're getting good advice at a fair price. So that's a big red flag. I think doctors are still making a lot of mistakes. And I'm surprised how many of them don't understand their retirement accounts. Whether they're the ones they can get individually or the ones they get through their employers, just understanding the ins and outs of them and how big of a benefit it is to be able to invest within those tax protected and asset protected accounts. A lot of docs just don't understand those, or even the difference between the accounts and the investments inside the accounts. So just basic financial literacy kind of principles that have never been taught to them in their science curriculum as undergrads, in medical school, in residency, and then all of a sudden they're out there making the big bucks and they have no idea what to do with them.
Now, I think one of your courses was in it titled Fire a Financial Advisor or something like that.
Yeah, it was a little bit provocatively titled. My financial advisor advertisers didn't like that title so much, but the truth of the course is the first module teaches you how to interact with the financial services industry. So it's not all about firing your advisor.
Now, can physicians really, or healthcare professionals in this day and age with all the volatility in the stock market, you have a lot of alternative financial investments. Can healthcare professionals really do it themselves these days?
Absolutely, they can. Should they all do it? No, they shouldn't. In fact, my estimate is that probably 20% can and should be their own financial planner and asset manager. The other 80%, the best thing I can do for them is connect them with someone who gives good advice at a fair price. Part of the requirement in order to do this yourself is you have to be interested in it.
Mm-hmm.
It has to be at least a little bit of a hobby for you. And it's the best paying hobby out there. Don't get me wrong. When financial advice costs thousands of dollars a year, this is a really well-paying hobby. But if you are not interested in it, if you are not going to do it well, you should not be doing it yourself. And so again, the key is to get in with someone that can help you.
So I've had a lot of physicians on this podcast talk about things like real estate and cryptocurrency. So I want to ask about those two things in order. So what's the role of real estate in a typical healthcare professional's financial portfolio?
Well, I think real estate's a great asset class. I own stocks, I own bonds, I own real estate. I think there are three big building blocks for any sort of a traditional portfolio. Big fan of real estate. I've got 20% of my portfolio in real estate. There's a lot of different ways to invest in it. Everything from a simple publicly traded real estate investment trust mutual fund, such as something you could buy at Vanguard for very low cost, all the way to, buying properties and fixing and flipping them and having long-term rentals or short-term rentals and really being involved in the day-to-day hands-on work of running a real estate company and everything in between, including syndications and private funds and that sort of stuff. There's lots of ways you can invest in real estate, but I think most stocks would probably benefit from adding at least a little bit of real estate to their portfolio.
What kind of questions should they be asking themselves? Like you said, there's like a whole spectrum of involvement when it comes to real estate. What kind of questions should healthcare professionals ask themselves if they want to dip into the real estate world?
I think the key is to match the type of investment to your desire. For example, I am really not interested in landlord. I don't enjoy it. It's not that fun for me. I don't like getting the calls from tenants. I don't even like screening tenants. So when I look at real estate investments, I'm looking for something more passive. So all of my real estate investments are more passive than that. I've been a landlord in the past. I know how to do it, but I don't enjoy it. And so do I give some things up in return for that? Yes, I pay some additional layers of fees. I don't have as much control over the investment as I might. There aren't as many opportunities to add value to it when I'm not in control, but it's worth it to me to give up those hassles. Somebody else, on the other hand, might want to be in total control of the investment and not have to pay fees to other people and that sort of a thing. And so they might be more interested in buying the property down the street and renting it out. But the key is to match your desires, your expertise, your time to the type of real estate investment. And I think if you can do that right from the beginning, you're much more likely to be successful as a real estate investor.
All right, next is cryptocurrency, and I have no doubt you get a lot of questions about cryptocurrency. I think Fidelity announced last week that it was going to be part of their retirement accounts. I get a lot of questions about cryptocurrency, a lot of articles on Kevin MD. Does cryptocurrency play a role in a typical financial portfolio?
I would not say it plays a role in a typical or traditional portfolio. It's definitely considered an alternative asset. There are all kinds of crypto assets, and every one of them is a little bit different. The use case for all of them are different, and they're fascinating to watch. I find the whole space super interesting to watch, not only from an investment perspective, but just from how is this going to change the world going forward kind of perspective. But looking at it purely from an investment perspective, should you be investing in this? Remember that just about all of these are speculative assets, right? It's like buying empty land. It's like buying precious metals like gold or silver. Essentially, if somebody else is not going to pay you more for it in the future, you are not going to make money on it. It is not going to produce any rents. It is not going to produce any dividends or interest, et cetera. There's no earnings for a lump of Bitcoin, if you will. And so it's a speculative asset. And I caution people to limit the speculative assets in their portfolio to a single-digit percentage. Something like 5%. So if you are a huge Bitcoin fan, you think it's going to change the world, you think it's going to go to 500,000, I still say you ought to limit it to 5% of your portfolio rather than 60% or 80% of your portfolio. I think that's just too big of a bet on a relatively new asset class. But I wouldn't feel like you have to invest any money into it. You're perfectly fine not having money in Bitcoin. Down the road, if Bitcoin becomes the changer of the world that everybody thinks it is, I had somebody write me this week that they think Bitcoin is going to end all the wars in the world, for instance. But you can always sell your stocks and your real estate and your physician services for Bitcoin. If it becomes actually a usable currency, it's not like you can't get it in the future. You would miss out on any sort of a speculative run-up, of course, but I would not feel like this is something you have to own. If you want to own some of it, own a small amount. If you don't, that's fine to watch from the sidelines, as I am doing.
And just to be clear, we talk a lot about these alternative investments like real estate, like cryptocurrency, but it's perfectly valid for a healthcare professional just to put everything into some type of total market index fund, something simple like that. That advice still applies this day and age. Is that correct?
I mean, I think index funds have huge benefits, particularly over actively managed funds or picking your own stocks. And so I'm a big fan of index funds. 85% of my portfolio is in index funds. That said, when you put all of your money into just a total stock market index fund, you're making a huge bet on one country. So I suggest that they also put some money into perhaps a total international
Hmm.
stock market index fund, maybe some money into bonds, maybe some money into real estate. If you want to dabble into some alternative asset classes in your portfolio, that's fine too. But, a total stock market index fund as your sole holding does carry some risks. And I think you ought to be aware of that before choosing that. It's certainly a very simple solution, but I think there's a better simple solution. If you're looking for something really simple, such as a target retirement fund, that gives you US stocks, international stocks, and some bonds all in one mutual fund. So I think it's a great choice, at least within asset protected accounts like 401ks and Roth IRAs, tax and asset protected accounts. I mean, a taxable account, that sort of investment has some issues, as some of those invested in Vanguard's funds learned last year.
We're talking to Jim Dahle. He's an emergency physician and he's the founder of the White Coat Investor. His most recent book is The White Coat Investor's Guide to Asset Protection: How to Protect Your Life Savings from Frivolous Lawsuits and Runaway Judgments. Jim, let's talk about your most recent book about asset protection. What are some of the key points that you want readers to come away with?
I want people to have a realistic view of what the risks are. For a lot of physicians, they really don't have that much at risk to runaway malpractice lawsuit. We're all very fearful of these, that they're going to clean us out and we're going to lose everything. But the truth of the matter is, there's probably a significant percentage of your assets that are not exposed to that sort of a situation. Even if there were a $10 million judgment against you, you would probably still be walking away with a significant portion of your assets. Now, this is all state specific. In some states, your entire house is protected. In most states, your retirement accounts are totally protected, even if you have to declare bankruptcy. And so I think having a realistic view of what the likelihood of you being sued is, number one, is helpful, because there's a lot of people out there selling complex trusts and that sort of a thing to try to convince you to spend a bunch of money and a bunch of hassle to protect yourselves from something that's really not that likely. I mean, the likelihood of you actually having an above policy limits judgment in emergency medicine working full time, I calculated out as about 1 in 10,000 per year. So it's not a very high risk, but it's not zero at the same time. And so it's good to know which of your assets are exposed, which are not, and maybe take a few steps to make a little bit higher percentage of your assets protected in that sort of a situation.
Now, if there was like one key thing that physicians should do to protect their assets, what would that one thing be?
Max out their retirement accounts. A lot of people don't realize that those are both tax protected and asset protected accounts. Your 401k in every state in the country, your IRA in almost every state in the country, is basically something you get to keep in the event you declare bankruptcy. And so that's probably the very best asset protection move we can make. Outside of date night, of course, you're far more likely to lose money to your spouse than you are to anybody else. So maintaining your marriage is probably the best thing. But beyond that, maxing out your retirement accounts.
And my final question, what are some of your take-home messages that you want to leave with the Kevin MD audience?
I think the most important take-home message I can give you is to actually pay attention to your finances. Realize you have a second job. You are not just a physician or an APC or a nurse or a physical therapist or whatever. You are also a pension fund manager. In our 401k world, there's nobody else doing this for you. If you don't do it, it won't be done. So spend a little bit of time on your finances, and you'll be surprised how much better it can make the rest of your life.
Jim, thank you so much for sharing your time and insight. Thanks again for being on the show.
Thank you for having me.